Hey, it's Tom here and welcome back to the channel. Slightly different style of video today. In this one I actually got the chance to speak with Tobias Carlisle. Now, Toby Carlisle is a quantitative style value investor that many of you may be familiar with already, and he's also written several books on the topic of value investing, including this one which I've got in my hand, The Acquirer's Multiple, which I've actually also done some videos on the channel in the past. So I was pretty excited to get the chance to talk to Toby on all things investing. We basically started right from the beginning at some of his background in terms of starting out as a lawyer in Australia and then moving to becoming a value investor in the US. We got into a lot of detail on his specific investment strategy, and at the end we also gave Toby some audience questions from a community post that I put up here on YouTube just yesterday. So hope you enjoyed this one. If you do want to check out some more from Toby, all of his links will be down in the description below, but for now let's get straight into it and I hope you enjoy. All right, we've got Toby Carlisle on the channel. Thank you for joining me, mate. How are you?
Thanks, Tom. Well, thank you. Thanks for having me.
No, I'm happy to have you on. I've been following the podcast for a couple of years now, and I'm not sure if you can quite see it behind me, but there is a copy of The Acquirer's Multiple back there somewhere, nice. which I picked up about a year or so ago as well. So been following you pretty closely and excited to chat to you. So I guess my first question is, you've got kind of like a quite interesting backstory. It's not the traditional sort of path to grow up in small town Australia and then become a value investor in the US. So talk us through that part of your life.
I grew up in Roma, which is in Western Queensland, which is like about 6 hours west of Brisbane. For folks who don't know, my parents moved out there when I was like 2 weeks old, and so I spent the first 15 years of my life. Grade 11 and 12 were at a technical college, so I went away for boarding school for grade 11 and 12, and then I went to University of Queensland, and I did business and law, and graduated, went to work for one of the big firms in the city, Cause, and then transferred to Minters, and eventually got transferred to the States. So they had a San Francisco office, and that's where I met my wife. We went back to Australia for a little bit, where I was general counsel of a telecommunications company, Pipe Networks, which got sold in 2008 or 9. I can't remember exactly, but so I had a little bit of money and a little bit of free time, and I wanted to learn about investing. So I knew a guy who was doing sort of very traditional, old school kind of undervalued asset situations with a catalyst, and that was kind of what I wanted to do. So I sat in there. It was like a quasi-activist shop. I always said he didn't ever intend to go activist, but he'd ask them to do some stuff and they'd never do it. So then he'd end up going activist on these guys.
Yeah, cool.
And that's sort of how I got started.
Yeah, nice. And this is all in Australia, the activism part of it, or was that in the States as well?
Yeah, that was just Australia. I started running, that got wound up in mid-2010. And so I started running my own partnership, basically didn't move desks, just stayed in the same desk because he was running his own money. And I started writing a little blog at the time called Greenbacked, which was just a way for me to kind of have a diary of what I was doing and have it out publicly so I could interact with people, not really thinking that much would come of it, but it was a good experience because I met a lot of people doing it. And it served as a pretty good record of what I was sort of thinking as I was starting out doing all this stuff. And I focused on the States because I didn't want to conflict with the guy I was in the office with. And I had a view that I was going to come back here eventually, which is what ended up happening.
Yeah, nice. And is it fair to say you're probably known for being more of a quantitative kind of mechanical style investor now? Is it fair to say you were focused more about kind of getting under the hood on individual companies in those early days?
Yeah, my initial strategy was, net sub-liquidation value with a catalyst in the form of, typically I like to see an activist in there because I was like, that's how you're going to get your money back. There's someone in there pushing to get the assets sold or get the company liquidated or whatever the case would be. Yep. And I looked at the end of 2010, I had a look at what I'd done for the last 2 years. And I'd done pretty well. Like you can imagine, if you deep value through 2009 and 2010, your returns are going to look pretty good. But I had gone through and sort of cherry picked out of like the net universe, which I had a pretty good idea what that had done. And just by virtue of the fact that I had selected, I've had my own bias in there, which is to buy stuff that's got the activist involved already, and a few other things like that. It underperformed what I could have done if I just bought every single stock in those screens.
Okay.
And I thought, there's something weird going on here. Like, what have I missed that I'm doing this to myself? And I found this James Montier, who's a pretty well-known researcher and writer. He wrote an article called An Ode to Quant, which was about these ideas that I'd sort of never heard of before about why you're better off having a more systematic process. And so I just started investigating. I started writing about it a little bit. I hooked up with a guy who's doing his PhD at the Booth School of Business, which is the old Chicago School of Business over here. It's a very good school for quantitative research. It's where Cliff Asness comes out of there and Fama teaches there. It's sort of a good quant school in the States. And I said to him, I want to write a book about this. Like, I've never really heard of anybody doing quantitative value before, even though there are quite a lot of people who do it. I just hadn't heard of them. It's sort of my own limitation rather than like them not existing. And so Wes and I did this analysis of, we found every bit of academic and industry research we could find that went back to like Grahamite type stuff, Benjamin Graham type stuff, like pre-25. Yeah. And if you've ever looked at those studies, some of them are based on, they're like trying to find the financial distress risk of a company. And so they looked at manufacturing companies, and they've got all these, like, what are the days payable blowing out, like all these kind of things like that as a fundamental investor, you might look at to see if a company's in some sort of trouble or not. They're just doing it in this sort of quantitative statistical approach. But they end up with these weird coefficients because they were basically doing linear regressions by hand, like least squares method. It's a lot of work. And so we were just like wondering, do these ideas still apply today? And so this book came out in 2011, but went back and had a look at, how do you find an undervalued company? How do you find a financially strong company? What does fraud look like, or statistical fraud? What is statistical earnings manipulation? What does statistical financial distress risk look like? How do you find, good margins and all these sort of things? We put them all together into a model and tested it. And the book is called Quantitative Value, which just sort of talks about the process of undertaking that research, which of the individual components continue to work. And so that's sort of very broadly how I do it today, just because I think that there's a lot of behavioral errors that it helps you avoid. And, in addition to that, I've spent a lot of time thinking about portfolio construction. And so this is just a way of, it's a way of sort of minimizing the errors that we would otherwise make, and trying to create portfolios that will deliver returns sort of like the underlying value and quality factors. I hate to say that word, but it's inescapable. You can look at the experience over the last 12 months, like when value does well, as a factor, my portfolio, my fund is going to do better. And my funds will do better. When it does worse, my funds will do worse. Like you as an investor, you whether you consciously or unconsciously know it, you have some sort of preference for these factors, and it will show up. And you might find that you're underperforming for some period of time and you don't know why. And then if you perhaps do a factor regression on your portfolio, you'll see, well, I'm a quality investor, and quality hasn't been doing very well for the last 2 years. And that's sort of why. It's nothing that I'm doing wrong, and I don't need to change my process. I just need to sort of understand my own style a little bit better. And so that's the only reason that I use it. It just sort of helps me contextualize where I am, find out where I am sort of within the world of investing.
Yeah, that's super interesting. And how are you, how are you defining value? Because you talk to a number of different investors. I guess you'll potentially have a more academic definition of that, and some people are more maybe DCF style investors. And I know you hate this quote being thrown at you, but Buffett says growth and value are joint in the hip, right? So how are you defining value in the way that you structure your portfolios?
So value is just any price metric to a fundamental ratio. So any enterprise value as a price metric, which is market cap plus debt backing out any sort of cash, and market cap itself is a price ratio, and then you just compare that to a fundamental metric like could be book value, could be earnings, could be cash flows, could be revenues, whatever you sort of determine is the best thing. I use a sort of combination of all of those things to and then I on the fundamental side, a combination on the price side as well. And so you're just looking for the cheapest things in the market, and then within that universe, trying to separate them out into the ones that have better balance sheets and better businesses. And so my definition of a pretty good business is one that has very fat margins, or in rising margins, or very stable margins, all of those things together, because that's just what are they paying their suppliers, what are they getting from their customers, how much are they keeping in the middle. And then you might want to look at how they're earning relative to their assets. Now, I have written a lot about why I don't like return on invested capital as a metric, because I think that it's very mean reverting. But it's not quite as simple as that. You don't want the very worst return on invested capital, because that doesn't tend to revert up to where you want it to be. There's a lot of businesses that are just set up, or a lot of companies that are just set up to spend money. So like the biotechnology company that doesn't have a product, they're just spending money hoping that they're going to find one. And that's true for a lot of tech companies. Nothing wrong with that necessarily. It's just that there's no, that company doesn't mean revert the way a company that has been doing very well at some point has got into a period where they've got lots of competition, or their inputs are really expensive, or just whatever has happened, their end customers aren't buying, whatever has happened, that company has the conditions in place for mean reversion. So the other companies don't. So that's sort of the way that I think about it. But the growthy guys, they're not necessarily looking at return on invested capital as their metric either. What they're looking for is just pure revenue growth. Now, you can test that as a proposition, as an idea. What is revenue growth, or growth in some other fundamental? How predictive of that is performance in a stock market? And pretty clearly, it's not very predictive over lots and lots of data that we have. So your best bets are you want it to be cheap on some metric, really doesn't matter, but I prefer the flow metrics, and I prefer an enterprise value type calculation because it includes the debt in there. I use EBIT because I use operating earnings, EBIT-based operating earnings, because you can construct it from the top of the financial statement down. When you add back stuff from the bottom, when you're adding back stuff to net profit to try and figure out where you are, you can be adding in some non-recurring items. So I just construct from the top down. It's a very simple way, and then compare that to the enterprise value. It's a very simple way just to get an idea roughly, what are we paying? What's this thing earning? And then we can spend more time working out whether this is something that we really want to own. Does it have good margins? Does it have a good balance sheet? And then what's management doing? Are management buying back stock? Are they issuing stock? Are they paying themselves a lot of money? Are they buying stock themselves? Mm-hmm. I think all of those things are, there's sort of trade-offs. You don't ever get the perfect setup. Very occasionally get the perfect setup, but almost never. You're handicapping. Well, it's a little bit more expensive, but it's a little bit better. It's a little bit worse, but it's much cheaper. Sure. Management's doing the right thing, or they're issuing shares, but everything else is good. And you've got to try to force rank all of those things and identify the best opportunities any given time. So that's how my model works to find things, and that's why I prefer. I prefer value that has the conditions in place for growth, mm-hmm. rather than something that has demonstrable growth showing up in like some sort of series of revenue or whatever.
Yeah, that's super interesting. And it sounds like you're typically screening and looking for a basket of stocks. Sort of you're looking for the cheapest basket of stocks relative to everything else that's available, or do you have some sort of absolute valuation sort of ceiling that you're trying to get under when you're building these portfolios?
Whenever I have done it on the basis of an absolute valuation, just by virtue of the fact that everything has got more expensive over time, and we're at the most expensive point now sort of that we've seen. So anytime you try to add in some sort of absolute measure, you invariably underperform because you kicked out earlier and earlier through your data set.
Sure.
So I think that it's easiest just to figure out what are the best opportunities in the market. And it's not just a value. This is a value plus, the other quality metrics that I discussed. So I can sort of weight them both together and look at which ones I prefer. But I still have I still have a preference for the things being cheaper, just because I think that it's, there are lots of companies that people pay up for that they, when you back out of what you're paying for and what it has to do to beat the market, like it's quite heroic what the company has to do. Whereas I just prefer it to be, if this company can keep on doing what it's doing without the market recognizing that it's doing well, it just keeps on earning and paying out that dividend, and it keeps on reinvesting what portion it doesn't pay out. If that over time will lead to pretty good returns, then that's the sort of position that I want to put on, because then I don't really care what the market view on the multiple is. I don't need multiple expansion, even though in many cases that is what you end up getting in the shorter term.
Yeah, very cool. And I guess what I probably should have read these books in a different order, but I actually read The Acquirer's Multiple first, and then I went and read Joel Greenblatt's Magic Formula, or the little book that still beats the market, which is, you guys are getting compared all the time, I think, with your approaches. I found it fascinating reading your book that I guess Joel Greenblatt takes this sort of combined approach to having some sort of proxy for business quality and some sort of proxy for just cheapness or valuation, and sort of combines the two to do like a quasi, I guess, Warren Buffett style approach, like taking the traditional Ben Graham approach of let's find some cheap stuff and then, adding the quality component on top. And I found it fascinating that just purely focusing on valuation seems to work better. That's sort of what you wrote all about in The Acquirer's Multiple. Do you have a feeling for why that is the case? Like, why doesn't including a return on invested capital or something help with performance?
I really like his approach, and I like the way that he did it too, because he sat back and he said, what does Buffett do? Mm-hmm. How can I simplify that down? Let me try that and see if it works. And then found out that it did in fact work, and publish those results, which is basically the way I think that this research should be done. Because there's a lot of, computers are so powerful now. Whether you do it via machine learning or whether you're just sort of doing the straight line regression analysis over the data set, you can data mine and find these relationships that aren't real. They just exist because you get a correlation that has no meaning, but they are correlated. There's a great website where you can go to and you can find all of these, they're spurious correlations. They're just like the number of pools in backyards, and the consumption of like milk or something like that. And the original study that talked about it was butter production in Bangladesh predicted the close of the S&P 500. And it's because you get 10 years of butter production in Bangladesh. Like, you got data series from all over the world. You just got to find the one that matches the closes for the S&P 500 the best. Yeah. And then butter production from Bangladesh turns out to be the one data series out of the hundreds that you could have chosen that fitted it. And of course, then the authors wrote it up and said, look, this is clearly butter production in Bangladesh doesn't predict the close of the S&P 500, but it just shows you can find these correlations that aren't real. And the author said, of course, as soon as we published that, we had people reaching out to us to see, how's butter production going this year in Bangladesh. So he did the research the right way. And I'm just sort of the kind of person who picks at a scab. When I read the book, it just immediately occurred to me that the way that he does it is he ranks every stock on valuation using EBIT/EV, same metric I use, ranks every stock on return on invested capital. Then he just sums the ranking. So if you got 2,000 stocks and it's the cheapest stock and it's got it gets a rank of 1. And if it's the best stock, it gets a rank of 1. So its combined ranking would be 2. And he does that for all 2,000 stocks. And it just occurred to me that you could have the cheapest stock in the market and it be the worst company on return on invested capital. Or you could have the best company in return on invested capital, and it could be the most expensive stock in the market. And I always understood investing to be, you've sort of got to be finding where the market is wrong in this stuff. And if it's the most expensive stock and the best stock, hasn't the market got that right? Or some combination of that. And so I thought, well, what is the driver of returns here? Is it the cheapness or is it the quality? And when we tested it, we found, and I've done this lots of times in lots of different data sets now, and lots of different countries, and it's always the same answer. Basically, that all of the returns plus more are driven by the value, and the return on invested capital tends to reduce returns. So if you just use return on invested capital by itself, you end up with worse returns in the market, because you're trying to buy these better companies, but you're paying too much money for them. So how then do you go about approaching this problem? Because you don't want, maybe you don't want bad companies in your portfolio, but maybe you don't care. Maybe you just want really good performance. So what I have found is that the return on invested capital tends to be picking these companies close to the top of their business cycle. And you just get them when everything has gone right for them. And they're expensive because everybody's recognized that everything's gone right and sort of assume that it's just going to keep on going right. And what happens is they tend to disappoint because they tend to mean revert down. So I think a better approach is buy the cheapest stuff in the market where everything has gone wrong for them. In many instances, they're appropriately priced and they keep on going down. About half the time it's wrong, but at the other half of the time, the market has got it wrong. And buying these positions, and you get a little bit of a turnaround in the business performance, and all of a sudden the stock price rockets up because they've been completely mispriced. And it's that the magnitude of the returns to those ones that work, even though the frequency is about 50-50, you end up doing better than the market and better than the magic formula combined. The downside to my approach, even though it does tend to outperform over the full data set, is it tends to be a little bit more cyclical. Whereas the quality metric or the return on invested capital metric tends to keep you up, helps you keep up with the market through periods of time like we've just gone through. So late 1990s was a similar period where you were better off with some sort of quality metric just because the market preferred better quality companies. And then the value metric held you back. But the value metric did then much better through the early 2000s. Last 10 years have been another period of time where you've been better off having more of a quality focus, but it seems to have flipped again recently, and value seems to be outperforming for about the last 6 to 9 months. So I'm hopeful we've gone back into a value type market, but there's a reason why you might want to use the quality metric too, and that's that it'll help you keep up with the market for these periodic sort of boomlets that we go through.
Yeah, I hope you're right, and it's turned around as well. So, why do you think it? Why do you think it is the case that that approach is so cyclical?
Yeah, I don't know. Honestly, it's I just think that the market goes through these regularly cycles between euphoria and whatever the opposite of euphoria is, depression. And when it's euphoric, nobody cares about the valuation, really. They're just looking at is this a cool company? Is it doing cool stuff? More than, what do the financial statements look like? But then if the financial statements are also, if it's growing rapidly year on year on year, top line's growing rapidly, most importantly, then those are the sort of companies that attract the attention. And the sort of stuff that I like just doesn't, it's already reasonably difficult stuff to understand. Like, you've got to dig into the financial statements and work out which of these are cheaper and which one of these you want to own. And it takes a long time for business quality to sort of out. It takes 3 years to 5 years, I think, for the business quality to be more important than the price that you're paying. So in the short term, it's a voting machine, as they say, and in the longer term, it's a weighing machine. But you can be hanging around for a long time waiting for the weighing machine to work.
Have you got any personal sort of tips on sticking with it through those cycles?
Well, you want to be you want the world to know what you're doing. So you have this external consistency bias that you have to remain consistent to what you're doing. But that's a double-edged sword, because the world does change, and you might be going down with the ship, and it's hard to know, whether you're doing the right thing and digging in, or whether you're, a buggy whip manufacturer and the world's moving on to a different place. But consistency bias is a good way of getting yourself to do something and sticking with it publicly. The other thing is that because I'm data driven, I look at, when I'm trying to decide if something's working or not working, I'm looking at a very long data period, and I can look at the full data set. People say, well, the accounting has changed and business has changed and people have changed, so that might not be appropriate. So I'd say, well, let's look at the last 20 years then, or let's look at the last 25 years. Let's look at the last 10 years, and let's see over those periods of time, like what were you better paid to do? Or does it make sense that the world has changed in this way, and this is the way it's always going to be? And I think that for value in particular, I could look at so I have a small and micro fund called Deep, and I set up Deep we got control of deep in June last year, and then switched it to a small and micro in October. And I could see in the small and micro universe that the yields were about 6%, which is huge, sub 1% as it was then, sub 1% 10-year world. Plus the growth was like coming up on 20% because they were just reinvesting at these very high rates. And I thought, if this doesn't work, do I really care if the market doesn't recognize that these companies aren't, do I care if they're not recognized? And the way that they would be recognized is by getting that multiple expansion. And I could just calculate that the return, assuming you don't get that multiple expansion, if the multiple just stays the same, you're going to outperform the market with those businesses. So I think that you want to be consistent with what you do, and you want to change very slowly, looking at historical data. And then you want to be thinking, what does the opportunity set imply? Like, as a value guy, I can go through and value these things. And one part of value is like, what's a fixed number that I would be prepared to sell this thing for here? And another way of valuing something is to say, what sort of yield am I getting? What sort of growth am I getting here? Does that yield and growth do better than other alternatives that I can look at, like the market or expensive stocks? And in both of those instances, I thought that they were being unfairly punished, and that the long run data set had shown that there were lots of periods where we have gone in and out of a growthier market and then gone back to a value market. The thing about value is it actually underperforms more often than it outperforms. It's just that when it outperforms, it does better. So you have to kind of be there for the periods when it outperforms. Yeah. And so knowing all those things, it made it a pretty easy decision for me.
Yeah, fantastic. And it sounds like, as far as I've seen, you timed that pretty well with kicking off the deep fund, right?
To get lucky.
Yeah,
that's the secret to this business. Get lucky.
Yeah, but I think it's also important to note that, like, you're doing the maths behind the scenes, and it's just one of those things that kind of smacks you over the head and said, yeah, like, how can this not work, right? It was getting to those kinds of levels.
The problem is in this business that everything's very short term. Everything's judged on a very short time period, and there's a lot of randomness. So you can be right and you can look like you're wrong for a long period of time. And that's the difficult thing for folks, because you just, once you've been doing it for 2 years or 3 years, you think it cannot be that this thing that I'm doing is right. Look at the performance, it's so bad. I've got to change to what's working right now. Of course, that's a trap, because that's what everybody does. And that's why most people have returns that tend to be worse than the market over time.
Yeah, it sort of reminds me of Michael Burry in The Big Short, where all his investors are getting very unhappy with him as he's waiting for this thing to fall apart, right?
Very similar. I've never had that problem, but I can imagine how stressful that was for him.
Yeah. How much time do you actually spend? I mean, because both of your funds are ETFs, right? They're not hedge funds where you're dealing with individual investors. How's that? I mean, are you taking calls from investors on a day-to-day basis or anything like that, or is it largely hands off now that everything's set up?
There's a lot of hands off. There's also a lot of people get in contact all the time with questions about what we're doing or what they want to see happen, and I always respond as much as I can to the legitimate questions. There's a lot of spam and trolling in there too, if you're a value guy.
Yeah, fair enough. You're a pretty long-standing one at this point. You're if Toby Carlisle ever folds on value, I think it's probably a good time to get in, because you're going to be the last one.
Yeah, that's right. I want to be the last man standing. That was my plan, to be the last man standing. Because just from a part of to be an investor, you need to be able to not so much, like, I think it is helpful to be a contrarian, but you don't just want to be a contrarian. You want to be doing the work in the background to make sure the position is justified. But you don't want to be happy that you're away from the market, or sad that the crowd is with you. But having said all of that, when you do find these situations when you contrarian and you feel like you're right, like, it's a very good setup for some good returns, some outsized returns, and you get, there's some credit that attaches to that. Like Burry's done it a few times now. He did it with The Big Short, which they made the movie about, and then GameStop. He was in GameStop about 18 months before it all sort of kicked off. So at some point, Burry gets some credit for what he does, but he's short Tesla at the moment, so we'll see how that all works out.
Yeah, we'll see how that goes. It's hard to say with the 90-day delay, because he's surprisingly short term as well.
He can be, yeah, that's right.
Yeah, and I actually have a friend who also has a YouTube channel that cloned Michael Burry into GameStop, so he's a very happy man at the moment as well.
Nice one.
Yeah. One of the interesting things that you also do that I don't know, perhaps there's other value investors that do it that I'm not super familiar with. I mean, Michael Burry's a good example, but people like Buffett and Pabrai are very open that they don't short stocks, and I know you do a little bit of shorting. So how does that fit into your strategy?
I short because it's simple enough for me to create a short portfolio and a long portfolio based on the model that I have constructed, so which sort of force ranks everything into a list. And then the shorts aren't necessarily the reverse of the longs, because it's not so much valuation that you want to be shorting on, just by virtue of the fact that something can be 2 times overvalued and proceed on to 5 or 10 or 20 times overvalued, and your signal's not getting any better when that happens. So the things that I short on are financial distress, statistical fraud, statistical earnings manipulation. And then if we can come up with a valuation, I would want it to be extremely expensive on top of that. And then I want it to have negative cash flows and lots of debt. All of these things together mean that they have some short-term funding needs. And so will the market bear their assets, their share sale? And so the way I determine whether it will or not is I just look at how's the stock done over the last 12 months. If it's up 30%, then they can probably jam a whole lot of stock down the market's throat. If it's down 30%, that's going to be a difficult ask, and they're probably going to have to take another big haircut to get that stock put away. So I use I'm looking for fundamental problems with the company and a very overvalued stock price and sort of a lack of momentum in the stock. And when all those criteria are together, then that's a pretty good short as a portfolio. And then I just keep them really small. So, it's pretty well known when GameStop blew up, lots of guys took off their shorts, and it got hard to be a short through that period of time, very briefly. And so I had a disastrous Q4 last year because all the shorts ran up. Q1 wasn't so bad because I already screen out the stuff that's the most heavily shorted. So I'm never kind of in ground zero with all the shorts who are bailing into these things. But because everything ramped up so much, I was caught even on the edges. The shorts sort of rolled up, and all the shorts trying to get out, that pushes up the short positions. But then that reversed in this quarter. So I don't mind shorting. I don't see why it's so different from being long, other than it is a little bit more risky. You need to keep the position shorter, and they tend to be a little bit shorter term positions. And I reevaluate on a regular basis, and we knock them back down. If it runs against me, this is the big difference between a long and a short. If the long goes wrong, you just lie in bed under the covers, and that problem sort of takes care of itself.
Yeah,
that's not true with a short. It keeps on getting to be a bigger and bigger problem. But you just got to have a sort of process around it. And so I just reduce. If it's running against me, I'm just taking the position down in size all the time, and it doesn't really matter if it starts running in my direction. I might start taking the position up again. So you just have to be very disciplined about them. And I don't worry too much about any individual position. I sort of look at it more as a portfolio, and I look at it as if the market falls over, this sort of stuff becomes really toxic in a market that's going down. Nobody wants to hold stuff that's losing money and overvalued and trashy balance sheets. And so it goes down more, and that sort of provides a little bit of ballast to the long portfolio, which would hopefully go down less because it tends to be net cash. And so the actual portion of it that's beta, if you like, is lesser. It's like got a lower leverage to the market. That's the theory anyway.
Yeah, gotcha. And I'd be interested to hear maybe some updated thoughts from you on this, because I saw some data out of AQR, which I think you initially spoke about this concept of like a value spread, which is ungodly wide at the moment. Do you think that's that's presumably like the ideal environment to be setting up this kind of strategy, right? Hoping that spread sort of compresses over time.
Yeah. So when I launched the strategy in May 2019, that was my argument at the time. The spread is so wide, like the spreads just don't get as wide as this very many times in the data. So I thought the risk here is that I will miss it. And so I had to launch into it, even though ideally you probably want to launch a value strategy closer to the bottom of the market. But that spread was so wide, I thought there's a possibility that we go through a 2000 type scenario where the expensive stuff just gets taken down 80 or 90%. Market could be down 50%, but value could rally through here. And it would be a disaster if, as a value guy, you're not set up to capture that performance.
Mm-hmm.
As it happens, I was a little bit early, and the spreads have continued to blow out for the 2 years really that I've been running the fund. Although I think that over the last sort of 3 months or so, the spread has started to close, and it feels good in the portfolio when it happens, because it means both sides of the portfolio are up, which just about never happens. But I would like to see more of it. I still think I don't think we've really seen the end of the growth phenomenon just yet, because I think it really does take a big market crash to sort of shake everybody out and remind them that there is risk. Because I think that what we've seen over the last 12 months is the market's gone up so much, and there have been so many of these 20 bag, whether it's in crypto or whether it's in these little like GameStop or some of these other growthier names. It's that sort of lottery ticket behavior that keeps people coming back, thinking that they can pick that lottery ticket. But when everything goes down a lot and you feel that pain over like an extended period of time. So I think of March 2020 was like a flash crash. It was down a lot. It was like an 87. It was down so much, so fast. But the thing that makes me nervous is more like if you go into a 2007, 2009 type scenario, or 2000 and 2002 scenario, where it's like 18 months to 2 years of every rally getting sold and finding a lower low until, you can count them in 2000, 2007 or 2009. I think there were 15 rallies that got sold. And it's that, you're 2 years in and you're down 50% and the 15th rally's being sold. That's the thing that makes people give the game away. And, that's the best time to be. That's the best time to be long.
Yeah, 100%. And I guess the sort of counter argument to that value spread would be rates, bro. And that those growthier stocks maybe deserve higher multiples potentially. Do you buy into that at all, or do you think this is something that just has to compress over time?
Yeah, I don't know really. Like it's the duration argument that you think about. The growthier stocks are like a longer term bond, like a 30-year bond. And if you go back to your finance 101 class, when you have a longer duration bond is much more sensitive to interest rates than a shorter duration bond. And when you drop the interest rates down, which is what we've seen, you get the long duration bonds go up a lot more. So growth stocks, because all of the cash flows are back end loaded, they're not making anything now. They're going to make all of their money in the future. They're more like those 30-year bonds. Whereas value stocks, which you can see them right now, they have a bigger yield now. They're kind of like a shorter term, shorter duration bond. And so they're much less sensitive to it, but also they tend to be a little bit, the businesses of them tend to be a little bit, they're not net borrowers. They tend to have cash and they tend to earn money on the cash. So there are a lot of influences and impacts on trying to make this estimation which way or how they're affected. So AQR, I think this is what you were alluding to before. AQR did this research where they looked at the slope of the yield curve of interest rates, interest rate levels, different, using the 10-year, using different, they used everything they could, and they couldn't find anything statistically significant in there. And I talked to Cliff Asness about it, and I said, it's a shame, because it's one of those things that intuitively, it really makes a lot of sense to me. But empirically, you can't find any evidence. So, what's going on? And he said at the time, I think I can brute force an answer, and I'm going to write a blog post rather than like a formal academic paper just showing how you can get a brute force answer. But it's never come out, so maybe he's not able to kind of to show it. I wish it was as simple as that, as it being rates. But then, if it is in fact rates, then we've got a little bit of problem too in the States, because I don't think they can get the 10-year much over 2% before all of the revenues of the federal government are consumed with interest payments on the debt. So it can't go up much. So the Fed, like the BOJ, was supposedly independent of the debt or the Japanese government. But when it came time to support JGBs, they had to step in and do that. And I think the same thing will happen in the States. Like you can see the 10-year ran up pretty quickly was sub 0.6, and it ran up to, I think it got to 1.7 or 1.8 or something like that. But it's been, I think that the Fed saw it getting there and we're just like, we'll just pin that thing under 2. And it's sort of been sitting there for the last kind of month, which is exactly the period of time that all of while value was sprinting up, and just kind of stopped as soon as that happened. So we've been drifting sideways over about the same period.
Yeah, it's a little scary anytime you start sort of comparing yourself against Japan, isn't it?
Because that's not a good place to be.
that's been a pretty painful one, and I don't think the States are the only ones that are got the money printer cranking and global rates. Yeah, it's definitely global at a much smaller scale for sure here in New Zealand, but pretty similar approach.
I think the Western world everybody in the Western world is doing it. I mean, everybody in the world. It's not just the Western world. China's doing it too. So I don't really know what the end game is, because I don't think anybody's ever done anything like this before. I've been shocked that it hasn't turned up in inflation. And it's one of the things that I always ask the guys who come on my podcast, who are sort of the more Austrian economics type guys, or the guys who are worried about money printing and inflation. So, what we've been printing all this money, like globally, where's it all turning up? And like no one really has a good answer. So I don't think that anybody really knows what's going on at this point. And I include myself in that group.
Yeah. Well, it's an interesting movie to watch anyway.
Yeah. May you live in interesting times, is the old Chinese curse, right? I think we're going to find out.
Yeah, absolutely. Absolutely. Hey, I'm just going to jump across to, I was telling you, I think off here, but I put up a community post yesterday on YouTube just to grab some subscriber questions. So if it's good with you, I think we might jump into some of those. So let's do it. And we've actually already covered several of these, but we had a pretty good question around basically like the number of positions you have on. I think you tend to have roughly 30 positions in a portfolio. Is that correct? Yeah. So is there a reason that the strategy doesn't scale to more concentrated portfolios or more diversified portfolios? What's the reason sort of behind the 30 stocks?
I wrote a book called Concentrated Investing, where I went and looked at academic approaches to portfolio construction, and they're all based on efficient markets hypothesis. And the idea there is that, there was a period of time when we didn't have an S&P 500 index fund. So how do you replicate the market? What's the fewest positions that you need in a portfolio, randomly selected to sort of match what the market does? Because it wasn't a trivial exercise to go and buy 500 stocks. You had to go, you were better off sampling. And so from that research, they say that somewhere between 20 and 30 positions, you get rid of all of your idiosyncratic risk. Sure. And you've got a portfolio randomly selected that should mimic the performance of the market. And then, additional positions beyond that, it might be too expensive to put them on. Now, the value guys have a completely different approach to that one. And their approach is basically, what are the chances that any given position blowing up takes down the whole portfolio? So if you've got one position, you're gone. If you've got two positions, half your portfolio is blown up. Three positions, it's a third of your portfolio blown up, and so on. And so I just looked at a survey of all of the value investors that we talked to, from Munger is very, very concentrated, but then you look at what he's concentrated into. He's concentrated into Berkshire Hathaway, which has got a very diverse number of holdings. Yes. Right. So he's not as concentrated as he might appear at the surface. But then I can test it too. So I can run my model back through all of the data. And what I found is that basically the main considerations are the sort of volatility of the portfolio versus the returns. And I just found that 30 positions was, for my model, through the back test data that I had, it gave the best balance of return and volatility. So I could get higher returns if I squeezed it down to 20 positions or 15 positions or 10 positions. Mm-hmm. But then you get this really alarming behavior out of the portfolio, where it might not do anything for 3 years, and then it might go up 3 times in a year. And it just sort of has this very volatile return path. Whereas if you get to 30 positions, the volatility kind of looks something similar to the market, but the performance is a little bit better. And I thought that's probably a pretty good balance of, and 30 is sort of what the academics say. It's what Graham said, there's a whole lot of smarter people than me who've been doing it, you know, for years, for decades, who've sort of all coalesced around 30. So there's really, it's just a matter of taste, really. I thought it gave the best balance of return and volatility.
Yeah, interesting. And presumably, like you say, once you start getting super concentrated, presumably the performance must fall off, because you do have these blow ups if you got 3 stocks and stuff.
Well, I think potentially that is true. I think I'm lucky just by virtue of the fact that the stocks that I like to buy are the ones that are pretty strong balance sheets. So there aren't too many donuts in there. So 3 or 5 does give you, again, it just gives you that more, it's much more volatile. Your performance is dictated by what the 3 stocks in your portfolio do. And you think of, there's 3 in the States, there's basically 3,000 sufficiently large stocks to fill sort of an institutional portfolio. You're saying I'm going to take 3 out of 3,000, so I'm taking 1/1000th of the stocks that are available at any given time. I think it's hard to even at 30 stocks, it's hard to tell the difference between the best value one in there and the 30th, because they're so idiosyncratic. Like the 30th position could catch a bid as you put it in, and it's up 35% or something like that. I just was. My thought process was, if one of these blows up, it's a 3.3% hole in the portfolio, and I can kind of live with that.
Yeah, you can survive those. Yeah. It's like, what is it? Buffett was calling himself the chief risk officer at Berkshire in the recent annual meeting. It's basically that, isn't it?
I think it's the only way to approach it. I really do think that that's the secret to it. You just take care of your risk first, and then that takes a whole lot of options off the table. And then with the sort of lower risk portfolio, then you're trying to generate the highest return that you can.
Yep, I like it. Okay, next question we've got is from Stefan. Do you have data on the effect of insider ownership on stock performance?
Yeah, that's been one that has really been a difficult one for me to show whether it works or not, because it makes total sense that if you have a concentrated insider who knows what they're doing, that they're at least aligned with you as a shareholder. The problem is that it's not easy to show it in the data, and there's no level of concentration that is significant. I think probably the more significant thing is what proportion of the holding is relative to this person's net worth. Yeah, and that's not something that you can determine easily. So if something is, if you got a 3% holding in a company and you're the CEO, but it's like 99% of your net worth, I'll bet you're watching it pretty closely.
Yeah.
But if you own 35% of it, you're Carlisle, you own a big chunk of it, but it's like some minuscule. It's a $100 million company and you're worth 18 billion, and you got big hold. You're not particularly concentrated on what that position is doing. I've never found a really good way of showing it. There are papers that show that there's an association between insider concentrated ownership and good performance, but in real time, it's very hard to sort of to tease it out and show it. I think a better metric is sort of what is a buyback metric, because it gives you a catalyst for them doing something. You can see, well, they're buying back stock, and if the company has the free cash flow there to do it, that's sort of proof that they are in fact generating real free cash flow, rather than free cash flow with air quotes around it that has to be then reinvested in capex. And if it's a sort of material buyback, then it's got to be the amount of stock that they're buying back relative to the fundamentals of the business has to be sort of commensurate. So if you have a super expensive company that's doing a buyback, they just can't buy back a lot of stock because the stock is so expensive relative to the size of the business. Whereas if the business is quite robust and throwing off lots of cash, but they're very, very cheap, they can buy back in, 10 or 15% of the outstanding stock, which is over a period of years, very, very material to the performance of the business. So I prefer buybacks to insider ownership. I like insider ownership, but I think it works better off if you're sort of a discretionary investor and you find there's a great CEO and he owns or she owns a lot of stock in the business, then that's probably a good signal, but it's not really a quantitative metric.
Yeah, I agree. One of the stocks I've been looking at pretty hard in the last year or so is Heritage Growth Properties. And you saw up until recently that Buffett owned about 5% of it, but it's like a $50 million position on $100 billion net worth. So was he losing sleep at night over Seritage growth properties going up or down? I think probably not. So I like what you're saying there. Next question we've got is from Karan Gunani. Karan's actually the guy I was mentioning earlier who cloned Bari into GameStop a year or so ago. So Karan is asking a bit of a Charlie Munger style inversion question. And he says, what are the requirements to be a bad investor?
Yeah, so you would want to be very emotional.
Mm-hmm.
Anytime anything happens to your stock, take like whatever the stock price does, that dictates how you behave. So if it goes up a lot, you buy more. If it goes down a lot, you you sell it. And you want to have as much leverage as you can, because that sort of takes out that decision for you. When you go down a lot, you get your margin call and you get kicked out. Yeah. So emotion is really the enemy. You kind of have to be, you want to be looking into the fundamentals, to the interior of the business, rather than sort of being dictated to on a price basis. And that's one of the nice things. That's really the thing that I like most about value, that before you look at the stock price, you can go and pull all the financial statements or go to your data provider, pull down, you can do your analysis, do your valuation on this thing, and then you can go and see where the market is. And many times the market's right about where your valuation is, or a little bit north of it, but occasionally it's at a big discount. And then all you have to do every quarter or every 6 months, however often they report, update your valuation and see where the stock price is. Pretty straightforward, very, very kind of calming approach to the markets, I think. Peaceful.
Yeah, absolutely. I like it. I know Guy Spear, I think, has talked recently about his new hobby is to just not look at the stock market. So that's quite a peaceful way of doing it as well.
I do the same thing. I don't look at it while the market's open. I think that's, it's enough to look at it when it's closed. I wouldn't even look at it when it's closed. It's just I get people who want to talk to me about how the portfolio is going. And I don't think it's acceptable to say, I don't know, but I would love to be able to say that.
Yeah, very cool. Right, next question is from Brad Kellner. What percentage of folks who start using the acquires multiple strategy do you think would stick with it for 10 plus years?
Well, it depends on when you start. If you start at a period of time when, when it all starts working, then you probably are convinced that it works. And if you start at a period of time when it's not working, then you probably think it doesn't work. And so it's dictated by that. And we've gone through, I started it in 2015, and it's probably the absolute top for that strategy. And it's been a very rough kind of it was a rough 5.5 years, and the last 6 months have been quite good for that strategy. So I think that, I've got some people who've been with me for a very long period of time, and they sort of started when the strategy looked a lot better, and then a lot of people have come in the interim. But I think that anybody who's joined over the last sort of 9 months, it's rocketed, and so I'd say they're feeling pretty good.
Yeah, for sure. It's fascinating to see the ebbs and flows of where people tend to invest their money. I know I'm blanking on the guest name, but you had some guests on the Value After Hours episode recently, and you're talking about the total the dollar weighted returns from the ARC funds getting close to zero, or perhaps even below zero at this point. And I think the ARC Innovation Fund is up like 5x or something over the past 7 years, right? It just shows those massive flows.
Well, it makes total sense, right? When the market goes up, more money goes into them, and that's sort of what pushes the underlying strategy up too, because ARC's sort of so big relative to the companies that it invests in. It's recycling those cash flows into those companies, which pushes up the returns, causing more money to flow in. There's a great example there's an investor, Ken Hebner, and he ran this CGM focus fund. I think I wrote about it in Quantitative Value. I forget the exact time period, but say it was like 2000 to 2010 or 2001 to 2011. The CGM focus fund did 18% compound over that period of time. And the average investor in the CGM focus fund lost 11% compound over that same period of time. Wow. And that's because when it runs up, the money flows in. When it runs back out, the money flows back out. And when it runs back up again, the money flows back in again. So people would if they just stuck with him through that full period, like 18% a year compound, that's a gigantic return. And he was Morningstar Manager of the Decade, even though the cash on cash returns in the fund for investors were negative.
it's pretty horrific, some of the emotion that goes on in these things, isn't it?
It's hard. It's a hard game.
Yeah, I've heard a similar thing with I don't know if it was quite that dramatic, but with Peter Lynch and the Magellan Fund, I think something similar happened. And
Sure.
I think you may have even mentioned it on a podcast episode a while back, that you came across a guy that actually did do it in the right order and basically like dollar cost averaged into Pagaya investment funds. Is that correct?
No,
Yeah.
that's right. His approach was every time Pagaya was down, he gave him more money, and so he outperformed Pagaya himself, which is it's really the only time I've ever heard of anybody doing that. But I've noticed it too in the funds that I run. When Deep had this great run from October through until February without seeing any flows, and then there was a Bloomberg article about it, and it got all of these flows. But it's right into that period of time where it hasn't really done anything for a month, and so all that money's sitting there. I'm like, I really need to get some performance now so that these people hang around.
Yeah, it's tough. We've got a few questions sort of to the effect of how has your investing strategy changed over time, and which I guess we sort of covered earlier with some of the more net investing and transitioning to more a quantitative approach. And the sort of a second part of that question, which is would you run a personal account kind of exactly the same as you run like what you're doing in the funds, or are you a bit more, would you be more interested if individual companies come up and dabbling in some of those things as well in a personal account?
I have evolved over time. I don't really know exactly how it has happened, but it's just I probably have more regard for business quality as I've gone along than I did in the past. Mm-hmm. In my own, I did have a PA until I started running the ETFs, because I just didn't think it was a good idea to have a PA with the ETFs. Yep. And now I just invest into the ETFs. But before then I was, my favorite strategy is like a leaps, or I like to use options, because options are, I think if there are very few places where you have an advantage, where you have a clear advantage. But as a value guy in options, I think you do have a clear advantage, because options tend to be priced on Black-Scholes mathematical models, and there's not quite as simple as that. There are everybody knows that the tails are fatter than the normal distribution that Black-Scholes would imply, so they're not perfectly priced on a Black-Scholes model, and you've got a very wide bid ask. But having said that, as a value guy, you can often find these scenarios where it's a binary outcome and it's not priced like, you on one hand you lose, how much you're going to lose. On one hand, you can make quite a lot, and so that just mispriced. And if you do enough of those, you get pretty good returns. So in my PA, I was doing that kind of stuff and doing pretty well with it. I would continue to do that. So it's still basically exactly the same model that I use for my investing. And all I would do is I'd just take the list of the large cap stocks, and I'd go through and I'd find the ones that had the lowest volatility, the lowest intrinsic value, intrinsic volatility, IV calculation. And that was often stuff it was a very good business. It's just that it got too expensive in 2000, or, it's too expensive at some stage. And it had just drifted sideways for a long, long period of time. Even though the underlying fundamentals were great and it was growing, it just takes it that long to grow into its valuation. And people get upset with it, like it hasn't done anything for a long period of time, so I'm out of this stock, or I'm not going to bid it. And so I would find those things. I thought they were trading cheaply. There's no volatility. And so I'd buy a 2-year leap. Yep. And that's the call option that expires outside of 12 months. And so you can often find them out to sort of, they typically, like the January 2023s are probably tradable now, something like that. So that's the kind of stuff that I just do funky option trades. And if there's a lot of vol, I might sell a put to get into it or something like that.
Yeah, that's really interesting. I guess like a Microsoft or a Walmart or something would be like the classic example of some of those things, right?
Walmart was one of my big hits in about 2015. It was exactly that scenario. The underlying was great, had just got too expensive. All of a sudden it was really cheap and there was no volatility. And it was funny, they were all pretty big stocks at the time. That was a really good time to do it in about 2015. I haven't looked since sort of 2019.
Yeah. Yeah, cool. All right, let's do one last question because I know you'll have some thoughts on this one. This is a question from Greg Beaumont. Buffett highlighted in the shareholder meetings that big companies may not be around in 30 years, but he also says never sell great businesses. So how do you identify which of your businesses won't be strong 30 years from now, and even if they have a moat? I guess you're probably not someone that holds for 30 years with a position. I understand you're rebalancing quite frequently, but do you have any thoughts on that, on what Buffett was saying there?
Yeah, so I've been doing a big project in the background on exactly this question because I'm interested in never sell as a proposition. And what I've been doing is just I can form a portfolio going back 20 plus years, and then just, ordinarily what happens with the system is that you just tell it when to rebalance, and it rebalances on some regular schedule, and it buys new stocks, reduces everything back to its equal weight, and then runs that portfolio for however long you've specified. And I had to kind of rebuild the system a little bit to do this because it wasn't set up to do it. So the system now does this thing. So I've been playing around with it for about 6 months, just interested to know what are the criteria that predict very long holding, like success over long holding periods. And it's hard, honestly, because you and I could agree on some quality things that we might like return on equity over 20%. We might want big fat gross margins, very high returns on invested capital, all of those sort of things. And you form a portfolio and you find that is all, it's predictive, out to about 5 years, and not very predictive out to about 5 years. The most predictive thing really is starting valuation, and that runs out about 5 years. But beyond that, you don't really care so much about the starting valuation. You now care more about the quality of the company. But you think about what's happened, like a high return on invested capital company over 5 years, if it's earning 20% a year, say it's paying out half and it's reinvesting half, that means that over a period of time, it's reinvested more than a third of it's a third bigger than it was, or 50% bigger than it was. And it can be quite a different business over that period of time. And so it's very, very hard to predict which of them will work and which of them won't. And so what I have come up with is basically, you don't even think about the portfolio for the first 5 years. You just form it and you let it run. And at the end of 5 years, if it's working and it's up, then you hold on to it. And if it's not working and it's down, then you just liquidate it. And those things that are up, they tend to be like, they're all of the winners, right? They're all of the things that are the famous stocks. So you end up with this portfolio over a period of time that looks like you've bought every winner for like the last 20 years, which is exactly what you have done. You've just trimmed out, you've just pulled your weeds. But then I think about the way that lots of guys talk about how they form like this is like lots of old sort of Wall Street wisdom. And that's one of the things that, like, water your flowers and pull your weeds, which is exactly what the strategy sort of does. And you end up with this portfolio that anybody who knows what they're doing, they look at the portfolio and they'll be like, oh, wow, you've got Microsoft, you've got Netflix, you've got Facebook, you've got everything that's kind of worked. And so you really look like you know what you're doing, but there's like a little bit of a secret in the back end of that you're just letting your winners run and, killing the things that aren't working. So but I do find, lots of things round trip in that portfolio too. Like, you got to be prepared to see something go up 3 times and then go back to 0. And all that stuff is easy to do in backtest, and it would be bloody hard to do in real time. I don't know how you do it in real time, but it's a kind of I would love to see this thing out in the wild. I would love to see this thing working. It's just I don't know if anybody has anybody has like I don't know if you could actually do it in real life. I think you'd be too tempted to sort of play around with a portfolio, because there are some crazy overvalued things in there, and you just be desperate to pull them out of the portfolio, because you know that they're too expensive. But then 5 years later, they're up another 2 or 3 times. So that would have been a mistake. It's tough. It's really hard to do.
Yeah, you probably got to be the guy sitting back here to do that kind of stuff.
That's it.
You got to be Charlie.
Or you just got to say, we never sell. We're going to buy these things, and I'm just going to tell everybody from the outset. And for a lot of these things, that's going to be the wrong idea, but for some of them, it's going to be a good thing.
Yeah, super interesting. Well, I know you're a busy man, Toby, so so I'll let you go. I've really enjoyed chatting with you. So, for those that somehow haven't come across you before already, where can people go to follow along with what you're doing?
Yeah, I have my Twitter account is greenbacked, GREENBACKD. I have a website, acquirersmultiple.com, and my fund is Acquirers Fund, ZIG is the ticker, and Roundhill Acquirers Deep Value Fund is the small and micro, and the ticker there is deep. And so any of those things, you'll be able to track me down and shoot me a note if you want to chat.
Great. That sounds awesome. And I will leave all that link down in the description of the YouTube video and also the show notes on the podcast if you're listening to just the audio format as well. But Toby, thanks very much.
Hey, thanks so much for having me, Tom, and thanks for not mentioning the Reds.
All right. Cheers.